Good afternoon, everybody. We hope that you and your families are well during this unusual time, and thank you for joining us today for our first of what is likely to be many virtual conferences. My name is Derek McPherson. I'm a Vice President and an Equity Research Analyst at Red Cloud Securities. We here at Red Cloud are of the view that this unprecedented stimulus being used to combat COVID-19 is going to result in a significant bull market in gold. And as we note in our recent research, getting ready for the gold to run, building our precious metals hoarding list, producers often see the flow of funds first in a new bull market. And so the reason we're bringing you our first virtual mini conference is 3 gold producers that we have under covers that we think are well positioned to outperform. I have with me on the call Paul Hewitt, Chairman and CEO of RNC Minerals, Tim Warman, CEO of FIORE Gold, and Mike Davies, CFO of Gran Colombia. For the webinar, each presenter has about 15 minutes or 13 minutes to go through their presentation, and we'll have about 5 minutes for questions after that from the audience. So please feel free to send in your questions now. And then the first to present will be RNC Minerals, and then FIORE, and then lastly Gran Colombia. When you are submitting your questions, please note which company you're asking the question of, just so we make sure that we direct it to the right questioner. And you can put in questions at any time. Our first one's already come through. Just to get this out of the way we'll get the disclosures out of the way first, and then we'll get it over to Paul. So for all 3 companies, there may be forward-looking statements made on this call. I would direct listeners to the cautionary note on page 2 of each company's corporate presentation located on each company's website. For Red Cloud Securities, Inc., I would highlight this webinar is for information purposes only and should not be considered a solicitation to purchase or sell securities or a recommendation to buy or sell securities. We note this call does not take into account the particular situation or needs of individual investors. Participants should rely on each company's on our website. So now I'll turn it over to Paul Hewitt, Chairman and CEO of RNC Minerals. Paul, go ahead.
Okay. Good morning here from Reno, Nevada. Thanks very much, Derek. First, I'll open up and reiterate what you said. I really hope and pray that everyone out there are keeping safe and keeping their families healthy during this very fluid, trying time in all of our lives. So I hope first and foremost that we're all taking care of ourselves and that you're all safe. So with that, I'd just like to begin with the slide deck that we prepared for this virtual mini conference, which is, I think, as Derek said, one of many. I think this is a real good opportunity for us to demonstrate and express the current position we're in. And as you'll see as I go through this slide deck, RNC is in a very unique position right today. Let me make sure I get this right. All right. So as many of you know, those of you who have been following RNC, the only thing in the last 6 months that hasn't really changed is actually the name. And I'll be very honest, that is something that before all this COVID-19 stuff occurred, it's something we're strongly looking at, and it's still something we believe should be changed in the near future. But another point is Western Australia was ranked as the #1 jurisdiction in the Fraser Institute, and that bodes well for us and our shareholders. Right now, we're presently able to operate our mines. The government has not shut us down. We're taking, obviously, a lot of precautions at our operations. In fact, we were very proactive in the very beginning. Actually, our managing director, Graham Sloan, hired a nurse, placed that nurse at the airport, screening people coming in, screening people coming out. We have daily calls, daily huddles, just based on COVID, making sure that our people are safe, making sure that we're not transmitting or spreading the virus. We're doing everything we can proactively to keep our doors open and making sure we're maintaining those social distances at all our meetings, at everything we do in the mine, in the mill, at all our locations. So while this is a very different time in everyone's life, I've been mining 30 plus years. I've never seen anything like it. We are adhering to all the standards, and mining in Western Australia certainly does give us some advantages, and we're seeing it now already. So I hope you can see the slides here. I'm on slide number 4, which is really a report card of our last 6 months, truthfully. It really shows some of the changes that we've done and some of the things that we've already undergone. So first and foremost, after we purchased the Higginsville property, which included the mine and the mill, we put out guidance. Our guidance was exceeded, and that's important to us because it sends a message and a signal that we're going to deliver on what we said we'd do. We delivered on our ounces by about 2,000 ounces, on our all-in sustaining costs. Have to remember, this was our first quarter, then first half a year ever owning the mill, putting everything up, integrating things. So we achieved our guidance on AISC as well. In fact, what I'm most proudest of the AISC is actually the trend. If you look at Q3, which was our first quarter, we hit at 1183, dropping from the previous quarter. In Q2 of 19, it was well over $1,300 an ounce. So we dropped. Q4, we dropped another $50 an ounce. The trend is what matters here, and we've been focused on 4 things, and I'll talk about those 4 things in an upcoming slide. But ending the year with a very, very healthy balance sheet. We ended the year with $34.7 million Canadian. It was actually $37 million. We used $3 million to pay down some debt. This is an important differentiator for us. RNC has never been in this type of position in the past before, where we have a surplus or a healthy, surplus is the wrong choice of word, a healthy balance sheet. We've got a very strong balance sheet. It will help us throughout these times, the uncertain times. Presently today, as I mentioned, our operations are still ongoing. Our guidance that we put out for the year is still something we believe we could achieve, provided we don't get forced or any government shutdowns. And that, if it occurs, will be beyond our control. You can appreciate we're anticipating, we're preparing for it. Hopeful it doesn't happen, and time will tell. But we certainly have a balance sheet where we can do it. We obviously announced a huge reduction in the Morgan Stanley royalty at Higginsville, and I'll talk specifically about that in several slides just to demonstrate how much this has unlocked. This has really changed this district in Western Australia. You can't help but be excited about what we've unlocked and the opportunities that we see in front of ourselves. We put together the first 2P reserve ever at our Beta Hunt mine. Right now, we're generating free cash flow. You know, today I looked this morning with the FX, gold is trading right at around $2,600 an ounce Australian. And we've been talking about our hedging. A lot of people have asked us. Our approach is that we don't want to hedge anything. We believe that investors are buying our stock because they want to take advantage of that torque and take advantage of the upside. We're very bullish on gold. The hedging that we have is something that we inherited. It was legacy hedges. I believe they'll be done in another 2 months, and then they're off our books. About 80% of our sales every month, it's right around that, are open to the current that market price. So again, today, sitting at around $2,600 an ounce Australian. So what a good place to be mining. The addition to the GDXJ, and what our strategy was. So these next 3 bullets really talk about what was our strategy. From the beginning, we had a strategy to attract new institutional shareholders. We love our retail shareholders. Let me just get that out there and make it very clear. We love our retail shareholders. We love all our shareholders. And we think about our shareholders all the time in every decision we make. But we know that having a large base of institutional shareholders will help us hold that fundamental share price and help us for the longer vision in what we do. So we've added well over 10 very high sophisticated institutional shareholders. We've made some changes to the board as we've been talking about, the addition of myself on the board, the addition of Warwick Morley-Jepson, who's on the board, Wendy Kai, who's on the board. So we've been changing up the board, and then finally the management team. As you know, I've been added as CEO. Barry Dahl has been added as CFO. Graham Sloan, who I'll talk about right now on this next slide. Graham Sloan, our managing director, was added in Australia. And I know some of you have heard me discuss this in the past, but I just want to highlight real quickly some of the efforts and initiatives Graham's already done. I know you've heard me say that he's reduced turnover from 87% down to 16%. Can you imagine today with what we're being faced, how that matters so much to our bottom line? In fact, most of our people that Graham and his GMs have attracted are local. That has had a tremendous impact on us throughout this pandemic that we're having. We have the ability, we're bringing in people that are more local. Our switch used to be 80% of our people used to be flown in. It's about, and 20% were local. It's almost reversed now. It's about 70% are local, 30% are flown in, which helps us tremendously in these times. So hats off to Graham and his team for making that huge change. Mill availability has gone up as we see quarter after quarter as we continue to deliver. Our productivity rates have come up over 30% in the underground. And each and every one of you understand how these metrics, they matter. They matter to our safety. They matter to our bottom line and to our shareholders. So I'm very proud of those efforts by Graham and his team. Looking forward to what we're about to do here in the future. And I'm going to stick to the time here. I'm already at 10 minutes, so I've been asked to keep it to 13 minutes. So if I speak a little quick, I apologize in advance. I do want to get the core message out about how RNC is a different company, different focus, and we have huge advantages today over a lot of others because of our cash position. 2020, when we look at what's in front of us, our guidance has been 90 to 95,000 ounces. We maintain that guidance. We put out an AISC of the similar range of last year, 1050 to 1200, completely knowing and understanding that's not good enough. We get it. It's not something we need to be pounded on the head. We're aware of it. We're targeting, as you can see, an AISC of $1,000 an ounce. And we will get there. We've been focused on 4 areas, and that focus is translated into our numbers, and we see it in our numbers. The results are speaking for themselves. So our vendors, personnel, and productivity rates, royalties, we've had one huge good success already. And G&A, we recognize that G&A needs to be dropped. We're making some tremendous efforts at making changes there as well. 2020 will be a very different year for us in Western Australia, where we plan to spend about $10 million in a jurisdiction that has had no exploration for years, almost 2 decades. So just to give a brief understanding of what has happened, since we unlocked that 1,800 square kilometers, we've identified not 1, not 2, but 5. This is really material, in my opinion. Look, we've identified 5 new areas that are going to be put into a pipeline or are already in a pipeline for us to be drilling. With over 17,000 meters of drilling completed, we've had some tremendous results. We identified that we did a huge geophysics, a gravity survey, identified a 5-kilometer strike jurisdiction just north of our mill. And before I switch slides, I just want to say that we had begun a lot of work on ore sorters. We think that could be an opportunity for us. And again, I say could. The initial results were positive. We don't have enough information at this point to make a decision. We are pleased with the initial results. We've seen anywhere from 20 to 30% potential of scalping material off. That translates into huge cost savings should that materialize into something going forward. However, we are also looking at optimizing our plant. What do we do here? We get 1 or 2 or more of these things adding. We're producing from 3 areas today. We've got the Beta Hunt mine, the Baloo that continues to grow and grow and grow, and then Fairplay North, which we've just started from our own drilling. So we're actually building a stockpile today, which again helps us and differentiates us. So I'm just going to talk to this slide here, and then I'm already at 13 minutes. So I just want to point out these 5 areas and just how important and how critical they are. So if you look at this map, that rectangle says Central Higginsville. Our mill is right dead center. You can see the tails to the right in blue there. The mill is right there at that location. It was built for that Trident underground mine, which produced 1 million ounces at about 8 to 10 grams. It was a very high grade underground mine. So let's just look at what those 5 targets are. So today, if you look on the far right, on the east, on the bottom side, You can see Baloo in orange. Hopefully you can see it. It's highlighted in white with red. Baloo, we're mining from Baloo. We're transporting that up to the mill now. That's 18 kilometers away. You look along that road, just follow the road to the mill, traveling west, you can see Hidden Secret and Mouse Hollow, how well they fit into our pipeline into the future. The Aquarius property is the formerly known Corona property. That area, we've had some exciting, very high grade intercepts. That looks like it has all the makings in the geology to someday become an underground target for us, and certainly something we're following up on. You see some of the results from Aquarius, 657 gram over 2 meters, 225 gram over 2 meters, 60 gram, 2 ounces over 2.3 meters. This is the kind of mining I've done my entire life. I started this kind of stuff in Timmins, went up to Yellowknife in Nevada. This narrow vein stuff is right up my alley. So this obviously creates a lot of excitement amongst this pipeline of material that we have in front of ourselves. And I'm going to keep the deck here, but I see that I'm already extended on my time. So I'm going to push forward to the end here and open it up for questions as I go through the slides. So this is just Fair Play, the pit we're mining on. Baloo, the one we're mining on. You can see the drill results. Baloo's initially, just remember, Baloo was scheduled to be done in January of 2020. We're now looking into 2021, and it is open as well here. This is not constrained by a fault or anything. This is constrained by drilling. So you can't help but be excited with all of these targets in this 1,800 square kilometer district. So there's our Higginsville property. We've got the historical resource. We're going to put out our own resource by the end of the year. Between measured, indicated, and inferred, we've got over 3.2 million ounces in Western Australia, one of the greatest jurisdictions in the world. So let me just, I know Derek's probably on the other end going, okay, Mr. Hewitt, anytime you want to wrap it up here. So I am just going to come to this slide and close up for questions here. So repeating myself, 2019 was a pivotal year for us. It changed this company's trajectory forever. We were a nickel company. We're a gold company. We're aggressive on cutting costs. We're aggressive on looking at opportunities for our shareholders. We began a transformation in this company that will continue into 2020. And we're excited about our strong treasury position. Q1 numbers, we talked a bit about, we're doing well despite all the challenges. We had a lot of challenges in Q4 as well with those bushfires and everything. We overcame them and still managed to add dollars to our balance sheet. And it's looking like Q1 is going to be similar, where we're faced with challenges, but we accept the challenge, we overcome it, and another strong quarter for us and our shareholders. So I'm quite excited about it, and I know I'm over my time, so I'll flip it over to Derek here at 17 minutes and 30 seconds. Apologize for being a little late. Thank you, Derek.
That's okay, Paul. It's a tight time frame. So we'll jump straight into questions. And we got this question multiple times, so we'll it's obviously one we should go to. A couple of people have asked about how the royalty negotiations are going with Mavericks on the Beta Hunt royalty.
Yeah, so look, that's obviously at the forefront of our mind as well. It's not something we're ignoring in any way, shape, or form. We've taken a very strong approach there. Let's just be transparent and honest. Maverick is not Morgan Stanley. This is their core business. So we always knew that it would be more challenging, but we always believed wholeheartedly that there's a mutually beneficial solution for their shareholders and for our shareholders. I'd like to keep it at that and say we have open discussions. It's ongoing. We recognize that it's high. They recognize that it's high. At their total royalty at between 6 and 1.5, plus the 1.5, you're talking a 7.5% royalty. It's a steep royalty. We believe there's opportunities to improve that for both sides, for both companies that are mutually beneficial. And I'd just like to keep it at that because I am under non-disclosures and I don't want to put anybody offside, but just say, we recognize the importance. We're not sitting on our hands. It is something that we're extremely, extremely focused on. But
Yeah, I think that's
I just want to add though, if you continue looking at our results and what we did with Morgan Stanley on the other end and the opportunities we have at Higginsville, there's no doubt we're not forced into a corner anymore. We used to be confined to Beta Hunt alone, Derek. Our lives have changed here in RNC. We used to be handcuffed to only having production from one asset. Time and time again, we're drilling and we're spending money and we're giving ourselves and our shareholders that flexibility. That's changing in our lives. We recognize that we have to do something there, but we also recognize we should have a backup plan and we should be making sure that we have multiple ways to fill that mill, despite whatever happens. So our results at Higginsville certainly speak for themselves. You can't take away those actual results that we've actually accomplished.
Yeah, I think that's that's an important part of it. Second question, and one that I'm also curious about, sticking with the Beta Hunt, a couple of questions about mining of the A zone near the Father's Day vein and when that's in the mine plan for if that's in the mine plan for 2020 and when in 2020.
Yeah, so look, it all lends itself into a larger strategy. Timing is everything in mining. We've got a lower level we're putting in. But I'd say that it's likely going to be 2020, but we're not rushing it as quickly as we need to. We're taking every right approach here into mining. It is part of our sequencing. We have other priorities, to be quite honest. We've got to find solutions, I believe, for our shareholders with your first question, first and foremost, and then accelerate those areas. So it's not going anywhere for sure. That district isn't going anywhere. And the only thing that's happening to us is, at least now, gold price is going up. We're pretty fortunate and blessed that we're getting ourselves in better position. So it's not the only area that we have to look forward to mining. There are a lot of areas in our portfolio now that we're excited about mining.
Great. I think that's a great spot to leave it. In the interest of time, we'll move on to our next presenter. Thank you very much, Paul. Appreciate the time.
Yeah, it's been great. Thank you and great job.
On this. So moving on to our next presenter is Tim Warman, President and CEO of FIORE. My apologies, Tim. FIORE Gold. Tim, I'm just we'll turn it over to you.
Thanks, Eric, and thanks everyone, and welcome. So we'll skip quickly through the forward-looking slide and just start with the key value drivers for the company. For those of you who aren't familiar, FIORE is a US-based gold producer. We have a producing mine in Nevada, another development asset right next door in Nevada that we're working on, and then an interesting third project in the US, which I'll talk a little bit about and which we'll have a bit more news on over the coming weeks. I should start off just by saying, again, we're in a very solid financial position. The company has no debt. We have a significant cash in the balance sheet. We had $6.5 million US at our last quarter, and that should be higher when we publish our current quarter, which just ended, obviously. We have a track record of increasing gold production from our producing mine, the Pan mine. We have a solid balance sheet, strong cash flow from that mine. For the current year, we're guiding somewhere between 45 and 48,000 ounces in our fiscal year 2020, and we have a slightly offset fiscal year that runs from the 1st of October to the end of September. And of course, that's always dependent on the situation with the COVID-19 pandemic. Obviously, the mine is running now. If that were to change in future, that might change our guidance, but so far so good. So Pan generates the cash flow to grow the company. The organic growth comes from our Gold Rock property. Gold Rock is about 8 miles away. Federal permitting on that project is complete. We completed that in 2018, so we're good to go from a mining perspective there. Still have some state permitting to do, obviously, but that gets done further along in the design and construction process. And for the first time, we'll be putting out a preliminary economic assessment on that project. It's never had one in the past. It's never had any kind of a technical study prepared on it. We are, I hope, days away from putting out the results of that. The COVID-19 issue has complicated that a little bit with people working from home, but I think we're almost there. And then really building on that operational strength that we've developed at Pan and targeting some strategic M&A, looking at complementary operations, ideally open pit heap leach type operations, obviously brings higher multiples, lower all-in sustaining cost, and really a part of the growth plan to get up to that 150,000 ounce per year growth target. That's really our near-term goal. I will just speak quickly to the COVID-19 pandemic response. We've closed our offices, as of most people. All the employees are working remotely. In Nevada, mining has been declared an essential service. It's been allowed to proceed, but we're taking very strict precautions and monitoring at the Pan mine, monitoring temperatures, personal distancing, trying to reduce the number of people we have there, very, very restricted access to the mine. And so far, that's worked very well for us. It is in a very remote area in northern Nevada. From a contingency planning point of view, we're currently mining, but even if we had to stop mining for a period, we've modeled this, and because it's a heap leach mine, we can't stop irrigating the leach pad. We have to keep the pumps running. We have to keep producing gold there. And so we have to keep a very small team on site to manage the solution flows. One of the advantages of having a heap leach is that even if you're not mining, gold continues to be produced through residual leaching, and that would go on for as much as 18 to 24 months, although we certainly aren't planning on any kind of a suspension of that length of time. We also use a contract miner, which means that if we have to stop mining, our costs reduce very, very rapidly and very significantly. I think we would be down to about 25% of our current run rate in terms of costs while we continue to produce gold. Gold refiners have indicated they're willing to pay for delivered gold, even if they can't refine. And I should stress that that none of these contingencies have come to pass yet. We're still mining, we're still delivering gold. But even if that were to happen, we would be in a very strong position to restart, a very strong financial position. Our operations are in the western U.S. The Pan mine, this is our cash flowing production base. It's a typical open pit heap leach mine in Nevada. Here's the mine from the air. Two pits, imaginatively called the North Pit and the South Pit. Ore is transported by haul trucks to the leach pad. We run it through a single stage crusher, leach the solution, and then produce gold doré in the ADR plant, which is then sold going on. We don't currently have any hedges in place, so we're selling gold at spot market. You can see the increase in gold production between 2018 and 2019. We had a 20%, 21% increase in gold production. We're guiding for somewhere between an 8 to 16% increase in production this year, year over year. And that very, very nice steady growth profile there. All-in sustaining costs running somewhere around the $1,100 an ounce range. Those will start to come down. We're currently in a high stripping period, but that's starting to fall away, and will fall away over the remainder of the year, and that will help bring down all-in sustaining costs as well. So with things running well at Pan, the main focus there is on extending the mine life. We're currently drilling. We've been drilling since the fall of last year, and we'll drill probably through the end of April this year. And then we'll go into a resource and reserve update and a new life of mine plan somewhere in the second half of the calendar 2020. One of the nice things about Pan is we have a very large land package there. It's approximately 200 square kilometers. The red zones you see on there all around the existing mine are targets that were identified by Midway Gold, the previous owner, but never drilled. And we're finally going to get out and drill some of those actually in the next couple of weeks. We think there's lots of potential to continue extending the mine life here for many years to come. And with Pan as that solid operating base, Gold Rock, the mine that's just 8 miles away, or the project that's just 8 miles away, former producing mine from the 1980s, is the source for organic growth. Gold Rock has about a 50 to 60% higher grade than Pan. It's at least 5 years ahead of any other similar project in the US because of that federal permitting that's already in place. We have a PEA and a resource update nearing completion. And you can see that Gold Rock is part of a long trend in here. You can see that red zone is the current resource area. It occupies about 2 or 3 kilometers of about a 16-kilometer long strike length of a structure that controls mineralization there. Again, many surface targets defined by us and by previous operators, almost no drilling outside of the existing resource area. And this is one of the reasons why Kinross Gold came in as a shareholder, because they really like the exploration upside potential of Gold Rock. The geology there is very similar to the geology at the nearby Bald Mountain mine, which has about 2.2 million ounces, on Kinross's books. And so they like the exploration upside here as well, just because of the geological similarities. With the PEA coming out, what we envisage for Gold Rock is really a satellite operation to Pan. It'll share a lot of the existing infrastructure. It'll share a lot of the existing management team, and a lot of the operations will really operate as a kind of complex, as opposed to two separate mines. You can see the power line, that yellow line that comes in from the west. That's the existing power line to Pan. Runs very close to Gold Rock. There'll be about a 4 kilometer or 5 kilometer extension needed there on the power line. The access road to Pan will be just simply continued on down to Gold Rock. And in terms of facilities, what we see happening at Gold Rock is an open pit mine with processing facilities, and then we'll take the loaded carbon and transport that up and use the existing facilities at Pan, the ADR plant up there, to strip the gold off the carbon. We'll refine and pour the doré there. We'll use the assay labs up there. We'll have the same management team, the same admin team. So really a lot of potential savings there, both on the CapEx and the OpEx side. So that's our growth project, our near-term growth project. We'd probably be looking at production somewhere towards the end of 2022 or early 2023 on that. Again, that's all a bit in flux. The next stage, once we get the PEA out, is to step straight into a feasibility study, and we're currently well-funded to carry on with that. Golden Eagle is an interesting property. It's up in Washington State. It was the third asset we acquired when we picked up these assets. And Golden Eagle currently has a historical resource of about 1.74 million ounces at 1.89 grams. It's a refractory sulfide ore body. That historical resource was done at $750 an ounce gold price. It's a pit-constrained resource. We are going to be coming up with a new 43-101 compliant resource estimate on that in the first half of this year. I think we're currently getting to the final stages on that. It's going to be a pit-constrained resource. And I think that'll really show the upside potential on this. I'm expecting it to be significantly north of 2 million ounces using current gold prices. One of the issues we have here, of course, is that the pit, which you can see in that green sort of shell around the ore body there, the ore body is entirely on our property, but the pit shell would have to extend into some ground that's owned by Hecla next door to us on both the north and the south. We've talked to them about a layback agreement. We've tried to, and lately we've actually started talking to them about, well, why don't we put these projects together and JV them? I mean, they have about 1.5 million ounces of an internal resource they've told us about on their side of the ground. If we put the new resource at Golden Eagle together with their resource and either spun this out or treated it as a JV, we think we can unlock a lot of value here. Those negotiations aren't going as quickly as I hoped, but they are progressing. And of course, one of the advantages is this whole project costs us about $10,000 a year to hold. So it's a very, very cheap option on moving that forward. We have a very simple share structure, about 98 million shares outstanding, about 31 million options and warrants. About 20 million of those are warrants that will expire in September, priced at about $1.60, so they're likely to expire out of the money. We had $6.5 million US in cash on the balance sheet at our last quarter. I expect that to be higher this quarter because we had quite a good production quarter this quarter. 24 US million in working capital, and of course a US market cap of about $30 million. So really our market cap is supported almost entirely by our working capital right now. In terms of analyst coverage, Stephen Sook at Stifel, Stuart McDougall at Mackie, and of course Jacob Willoughby at Red Cloud. I'll just wrap up here. We've tried to under-promise and over-deliver. We said we'd get the Pan mine ramped up and generating cash flow, and we've done that. We've said we'd extend the mine life. We've done that, and we're planning to do that again this year with the drilling that we're just wrapping up now. We said we'd get the Gold Rock project permitted, and we've done that. We said we'd get a crusher installed and operating at Pan, and we've done that. And we've divested the remaining Chilean project, and we've done all of this without taking on debt, exclusively from our existing cash flow. Upcoming catalyst, the Gold Rock PEA should be out any day now. We'll go straight into the Gold Rock feasibility work, and that'll carry on through the remainder of 2020. We've got Pan resource expansion drilling happening right now. Reserve and life of mine update at Pan in the second half of this year. And then hopefully this year, making some progress on consolidation of some smaller producers to really add a second and possibly a third asset and get our production profile up closer to that 150,000 ounce a year target that we're shooting for. And again, finally, the Golden Eagle resource update will come out in the first half of this year. And I'll just wrap up with a nice picture of the Pan mine looking north across the south pit off towards the north pit in the distance there. Thank you.
Thanks, Thanks, Tim. So we do have a few questions from the line, so let's jump to those. First is on Gold Rock, obviously your growth asset. You talked a little bit about the timeline with obviously the feasibility study and permitting, et cetera. When do you think that you would sort of be pouring first gold from Gold Rock?
Yeah, it would probably be in sort of late 2022, early 2023. It depends on how quickly we can get through the feasibility study. I think we're well poised to do that. We're planning to kick off some of the field work for that feasibility study very shortly, once summer starts or the spring weather starts hitting Nevada. And that's kind of the general timeline we have now. We'll obviously get a better update once we have the PEA out and we see exactly how much more work we need to do to get that feasibility done. One of the nice things about Gold Rock is that I think our options for financing that are a lot broader than a lot of companies, mainly because it's seen as more of an expansion project to a currently cash flowing asset as opposed to a brand new greenfields project. So we're hoping the funding will take a lot less time as well.
And then I guess you talked a little bit about growth potentially through M&A. This is a question from the line. Were you frustrated to see Alio end up merging with Argonaut?
Yeah, not really. It's we've tried to be very selective about the projects we look at. We had looked at that asset back when Rypatch still had it. Alio came in and bought it, obviously at a price that we weren't willing to pay for it. I think we like to look at assets where we think we can add a lot of value, and where we can pick them up at a reasonable price. I think that probably made sense for Argonaut. They wanted to diversify out of Mexico, and it wasn't the one that got away for us.
Okay. And then a question about the existing working capital for FIORE. Maybe a bit of a technical financial question, but how is your cash being held? And then maybe talk a little bit about the working capital.
Yeah, so we have the $6.5 million that shows up on our balance sheet at the last quarter. That is free, unrestricted cash sitting in our bank accounts. The remainder of the working capital is inventory in the leach pad, because the leach cycle is as long as with any heap leach pad. The gold you put on the leach pad today doesn't come off in some cases for about 18 months. I mean, we get the bulk of it off in the first sort of 3 or 4 months, but there's still that long tail of gold coming off the leach pad, and so there's inventory buildup in there. And one of the nice things we're seeing is the inventory build is flattened out, which suggests that the leach pad's in more or less in equilibrium there.
Yeah, that's usually a good sign. The last thing you want to see with heap leach projects is a perpetual build of inventory. And then a question from another viewer about the South America. Previously, FIORE had South American properties, and if they're still around and what the plan is for those.
Yeah, no, we announced we just divested the last of the projects there. We basically are allowing another company. It's a private Chilean company to earn in our last project down there. And I think the problem is that right now, I mean, our focus is really on North America and on the U.S. in particular. We sort of pivoted to becoming a gold producer a few years ago, and trying to run those Chilean exploration assets was beginning to be a bit of a distraction and a fairly expensive one at that.
Okay, and then the last question from the line is maybe talk about. Can you talk about potentially who, as much as you can disclose, who your major shareholders are, and then how much management holds?
So I'll start with management and directors. Management and directors hold about 5%. Kinross is a major shareholder. They own just under 6%. Don Smith and Company, an institutional fund out of New York, owns a similar proportion, just under 6%. And really, the rest is fairly broadly held by retail investors. There's probably about 35 or 40% of the stock in Haywood in Vancouver, but again, it's spread out amongst a number of retail investors there. But it's a pretty broadly held stock. We don't have any major controlling shareholders.
Okay, and then this is a question for my partner Jacob. He wanted to ask about how much stripping you plan to do in half one of this year versus half two, and how that's going to affect your cash flow.
Yeah, so the stripping ratio at in the first half of the year was probably closer to 2-to-1, which is a sort of historic high for the mine. The mine, over the life of mine plan, there was a bit of a hump in stripping, which we're just coming through now. And as we tail off, really starting in about May, that stripping ratio starts to drop quite rapidly. So we'll be down to about a 1-to-1, or maybe even a little less than a 1-to-1 strip ratio by the end of the year. Now, again, we're going to be redoing the life of mine plan as based on all this drilling we've been doing over the last sort of 6 months. And so that may change going forward, but for now, it looks like the strip is going to drop away fairly significantly. And that obviously has a big impact on cash flow, because every ton of waste rock you move is a non-revenue ton. It just adds cost. It doesn't add any revenue. So anything we can do to get that strip ratio down improves the profitability of the mine fairly significantly.
Okay, great. I think that does it for questions that we have for you, Tim. Thank you very much for giving your presentation. And with that, we will go to our next presenter, Mike Davies, CFO of Gran Colombia. And with that, Mike, we'll turn it over to you.
Great, thanks, Derek. Well, good morning, and thanks for joining. And as the others have echoed, we do hope everyone's staying safe during these times. It certainly is very different working the way we're working these days. I'll go past that. So for those of you not familiar with this, we are the largest producer of gold in operations, located in the sort of the northern part of Colombia, north of Medellin. We own 100%. It's a high-grade project, one of the top 5 underground gold mines by grade globally. Our other flagship project is now owned by a company. It's a separate listed issuer called Caldas Gold. Just started trading in February 28th on the TSXV under the symbol CGC. And we spun out our MARMATO mining asset, essentially focused on the expansion of the underground mining operations there, and retained a 74% interest. Our Zancudo project, which is an exploration stage project, is right now under IM Gold, who are drilling. And we also have equity investments in GoldX Mining, 21% of that company, which is pushing forward the feasibility study on the Toro Peru project. And Western Atlas, we hold 20%. They are currently moving towards drilling their Meadowbank project next door to Agnico Eagle's producing mine. And they have an option on our Venezuelan interest, should that open up at some point for future exploitation. We've got 60.8 million shares outstanding at the moment. We did a private placement in February of this year and added a few more shares and warrants, but brought in some more equity institutional holders into the company stock, 88.7 million fully diluted shares. We've had a great resurgence in the stock price over the last 2-3 years as we've implemented the turnaround story. Took a hit, much like everybody else did a couple of weeks ago with the COVID-19 situation, but we feel very confident in the long-term value of the company and expect to see that turnaround once the markets get a little bit more normalized again. We released our year-end 2019 results on Monday night. Yesterday did our webcast. So next few slides, I'm going to pull from our year-end webcast we did just to give you an update on the results that we reported. This was a record year for us in gold production with 240,000 ounces. That was the top end of our guidance. We've now got adjusted EBITDA for last year of almost $147 million. So we're trading at the current prices at less than 1.5 times EBITDA. Our adjusted net income, after we take out the impairment on the upper zone of MARMATO where we don't mine, and all the financial institutions or instruments benchmarking we do, came in at 60.5 million, another record for us. And our free cash flow yield is something that's getting a lot of attention, 60.6 million. That's up over 30% from the year before. So very strong set of numbers for us coming out of the fourth quarter from last year. Our gold production, we've more than doubled in the last 5 years. We've focused on the optimization of the high-grade SEGOVIA project. It does about 90% of our production. And you can see SEGOVIA reached over 200,000 ounces last year. And with MARMATO, we're up at 240,000 ounces. And that production has largely been driven by the work we've done opening up the lower veins at El Silencio through dewatering the mine and going after the high-grade material that's down at the depth of the mine, as well as the development work we did that brought us into the lower, much higher grade areas of Providencia about 2 years ago. The Sandra K mine is the younger of the mines we have at the moment, and it's seen some increase last year as we've gone now into the second year of production since bringing it back on stream after developing it for a couple of years. And our small artisanal contract miners increased last year from 11,000 to 16,000 ounces as we qualified a number of mines and brought them on after our onboarding procedures, validating their health and safety processes and all the other compliance factors. So a strong year on all different fronts for us at the mines. MARMATO picked up their grade in the fourth quarter, so they did a very strong year as well at almost 26,000 ounces, which was the top end of their guidance. And so we really have a strong set of operating mines going forward. And we do expect that we'll bring our fourth mine into production later this year in Segovia. It's the Carla mine. So it's about 14 kilometers south of the plant, and it's gearing up to start doing some production later this year. We also released a reserve and resource update for Segovia on Monday night. After another year of exploration, 36,000 meters drilled. We reaffirmed the high-grade nature of the title. We increased our measured indicated by about 2%. And after taking into consideration what we mined last year, that means we added about 360,000 ounces to our total resources last year. We replaced everything we mined in the reserve category and extended the life a little bit further in our reserves. So very pleased with the results last year, and looking to do about another 45,000 meters this year, subject to what's transpiring with COVID-19. But this year's strategy will have about 70% of the meters targeting the existing mining operations and about 30% stepping out now as part of a regional program, going into the old mined out areas of the other 24 veins that we know of that we aren't currently mining. And that is extending our reach within this 3,000 hectare title to look for areas to expand for the future mining of Segovia. Revenue hit another record year for us last year at 326 million, driven primarily by the growth in gold that we've seen over the last couple of years and receiving a boost in the second half of the year from the higher spot prices, which brought us to almost a $1,400 average realized price last year. And from the cost perspective, I think the most important takeaways here are that Segovia's costs are relatively stabilized in that low $600 level. We optimized the mine cost back in 2015 when we implemented the optimized mine plan. MARMATO, on the other side, hasn't received the same level of attention. It's only about 11% of our total production and sales at the moment, sitting up around $1,100. But with the PEA we released last year, the plans moving forward with the optimization plan, we think we can bring that down about 30% and have it somewhere in sort of that $800 an ounce range going forward. So that's the future for MARMATO, is reducing cost and increasing production and really turning around the status of that mine. Our all-in sustaining and all-in costs, again, have been fairly steady over the years. Our capital allocation really has driven that as we've been reducing the debt on our balance sheet, making sure there's enough free cash flow coming out of the operations to fund our balance sheet structure. But at the same time, focusing on everything we needed to do in Segovia as far as the project. This year, you can see the gap between the blue line, which is the realized gold price, and the all-in cost is widened, and that is one of the drivers behind the free cash flow this year. Our adjusted EBITDA, another record year, as I mentioned, $147 million. And you can see in our cash flow metrics that's flowing through, it surpassed the 100 million mark in operating cash flow this year. That's after paying about 35 million of taxes last year. We received about 60 million free cash flow out of that, and that's been really the driver for us to continue strengthening the balance sheet of the company. We've gone from having about 140 million of debt and 3 million of cash back in Q1 of 2018 to a situation where debt and cash are equal by the end of Q4 2019. And if we roll the tape forward, yesterday we repaid $20 million of our gold notes. We brought the principal of the gold notes down at the end of March, now to 45 million. That's less than half of where we were 2 years ago when we issued them. So extremely excited about how that's transpired for everybody. And our cash balance is still sitting around $80 million at this point. So very healthy balance sheet to continue pushing this journey forward. The future of MARMATO lies underground. We've talked about the formation of Caldas Gold. There's the box in the middle of this chart really just trying to give you an indication that Zona Baja, The one single title that we own in the middle to the bottom of the mountain is where we're focused on Caldas Gold. The mining upper zone is where the existing mining operation is, and we're going to be optimizing it, as I said, to reduce dilution and increase production there. This year's guidance is around 32,000 to 37,000 ounces. Caveat that, obvious, depending on how things are progressing with the situation with COVID-19. The future really is developing that mining deep zone, putting in a second mining operation with a 4,000 ton a day plant, raising production total from this to over 150,000 ounces by 2023, and taking a little bit further than that down the road. So a very exciting project we have as we're moving forward with Caldas Gold. And one of the things that really excites us is the exploration potential coming from the drilling that we've completed since the PEA drilling was finished. You can see the circle area there. This is the lower deep zone. The main zone in yellow is where the PEA mine plan is built, but drilling since then has shown a parallel new zone with some very broad widths with very good grades. So you can see the one hole there, the 50 hole, 76 meters at 3.12 grams solid. The 53 hole, 87 meters with 3.9 grams solid. These are very good intercepts for us. We believe there's a parallel zone. We're going to do some more follow-up drilling, and none of this is included in the current resource plan or mine plan for the deep zone. So this project for us keeps getting bigger the more we drill, and extremely excited about it. We are in discussion on the financing already for the expansion of the mine. As we've announced, we are looking potentially at streaming. We are also looking at potentially another round of gold notes and potentially even an equity offering. But we'll work on all of that stuff over the next several months, putting it together. But the future of this Caldas Gold company for us is extremely exciting. People this morning and I've been talking about COVID-19. I think much like the others, we've got all the procedures in place to keep our people safe, both at the mine and in the communities we operate. Colombia is under quarantine right now. Looks like that'll probably be extended to the end of April. We are still able to continue mining at both of our projects. We've had experience with this, unfortunately, back in 2017 when we had a civil disruption in our title in Segovia. So we do know how to operate in these restricted kind of conditions. Our CEO, Lombardo Paredes, who not only gets the credit for the turnaround in production and operations the last few years, is leading the charge with our response plan. And we're doing everything locally that we need to do and working with the communities. And so much so that, we're working with our local foundations that we fund to provide food and water to the communities. We've got people working remotely, certainly in Toronto and in Medellin, but also in Segovia and MARMATO. We're doing everything about site and camp hygiene, et cetera, that we need to be doing, and social distancing's become the norm. So we expect that our first quarter, which will have the results out in a couple of weeks, production will look pretty normal. April, still sort of early to tell. We do have the mill running at fairly full steam. But the thing we have to watch a little bit is grade over the next few months, where we are using some of our stockpiles to fill in the gap, and they're not necessarily at the same height as some of the veins we're pulling from, but we're cash flowing and we're continuing to operate, and we're keeping everyone safe in the process. So with that, Derek, I turn it over to you.
All right. Thanks, Mike. We'll go to some questions. So there's several of them. Maybe one to start at a higher level. Obviously, operating in Colombia is not a normal jurisdiction for some of our viewers. A couple of questions about the political risks in the country and how you guys are able to manage that.
I think one of the advantages this company has always had is our on-the-ground presence in Colombia. Our full management team, aside from myself and a couple of the others in the office that really support the public company end of it, are all located in Colombia. We have connections at all different levels. We work in the mining association. So I think our strong local connections in Colombia help us in terms of how we operate on a daily basis.
Okay. Yeah, that's important. And obviously, both MARMATO and Segovia are unique titles there that you guys were able to secure. So with those connections. I guess I had a question about a couple of questions about your investee companies, the companies that you're invested in. But maybe talk a little bit about that strategy of investment, and then also comment specifically on Goldex.
Yeah, so I mean, as you can see, we've narrowed down the field to a very tight focus. We want to be ultimately focusing our free cash flow on SEGOVIA. We've done so much work the last couple of years to bring strength into our balance sheet that spinning out the underground expansion of MARMATO, which is going to take about $250 million US to complete, was the spin out really was a way for us to compartmentalizing all the project financing in a separate vehicle, not encumbering both the balance sheets and cash flows on a daily basis of Gran Colombia, but also not putting any more stress on the capital structure of Gran Colombia. But retaining a 74% interest means we're going to get some valuation over the course of this for our shareholders. Toro, Peru, and it was an opportunity for us. It was an asset that, in a jurisdiction that our management team has had a lot of experience before in the Venezuelan side of the Guyana Shield. Serafino and his partners have built several mines on the Venezuelan side that have been very successful for shareholders. They know that territory well. They liked what they saw in Toro, Peru, and we see that as an opportunity. We are an equity partner. We're not looking to buy out the project and take it over. We're looking to be a partner, and you can see the recent activity where we and FIORE and Wheaton even got together to fund it with $20 million through a convertible debenture to help it secure the option on the land title so it can move ahead. So we see value in this company. It's got millions of ounces. It's got a very good future ahead of it for mining, and we think that it's a good investment for Gran Colombia. And the Western Atlas for us, not as much about the Nunavut property, although we have sent people to look at it. We think it's a very good project, great prospectivity sitting right on trend with the Agnico project. Excited that they're going to move ahead with drilling. And we saw it more so as an opportunity to have a shell lined up that when things change in Venezuela, we've got a vehicle to put those rights and again, compartmentalize them outside the mothership for future development.
Okay. And then maybe specifically on Calidus, obviously you guys just finished actually buying some shares in the market on Calidus, but is there is the plan eventually for Gran Colombia's interest to be diluted below that 74%, i.e. raise money from outside investors specifically for Calidus?
Yeah, I think you're going to see Gran Colombia, probably at a minimum level around mid-60s is where we would sort of settle on any financing we're doing. If there is some financing on the equity side, we may put in some order to, protect our position and keep it there for our shareholders. But we bought back some shares recently when the softness in the market right around the middle of March. It was just too good not to pick up some additional shares and support the stock in its early days of trading. But we don't have an interest in taking it much higher at this point. The real focus in us is putting in the long-term financing now to take this project forward.
Right. And then maybe focusing on MARMATO. Obviously, last year you announced the optimization plan. Some of that work is sort of effectively supposed to start now, leading up to the larger expansion. Is the COVID-19 impacting any of that optimization work that's ongoing at MARMATO?
To a degree, it's affecting, I think, everything for everybody. Obviously, we are already underway with the optimization plan. We're getting some good early indications. I think going on the optimization plan is going to help that company as it goes through addressing the COVID-19 situation, because it is helping us to improve the cash flow during this situation. We're still drilling on the project. We've got our 3 real rigs going. The one challenge we're going to have is that getting our assays to the labs, the SGS labs, obviously is going to be difficult with the labs being shut right now. So we probably won't see a drilling update till middle of June, but we are continuing on behind the scenes. SRK is continuing to work on the pre-feasibility work. We're doing everything we can remotely to continue moving forward with the project.
Okay, and then maybe back over to SEGOVIA. A question from the audience on Carla, and when you expect to be able to bring that into production.
Yeah, so the plan right now is be late in the third quarter, early fourth quarter that'll come on. It won't be a great big ounce contributor this year, given the start later in the year, and it's not as you look at the reserves, it's about 50,000 ounces in total. So it's probably, sort of about a 10,000 ounce a year type producer over the next couple of years. We are continuing some more exploration there. So it's not a significantly large mine like the Providencia mine or even the Sandra K at this point, but it's an indication again that there are areas within the title, and this one being just south of the title and a separate one we have, where we can get some good grades, develop some more production, and that's sort of the footprint that we think is going to come out of the exploration work we're doing in the 3,000 hectare title in Segovia.
Yeah. And then I guess on that exploration work, obviously you guys did some AI work to help with the targeting. Is that something that you're seeing fruit from, and then is it something you expect to continue going forward?
Yeah, the work we did with Goldspot last year, we took a leap to see, how does AI and machine learning help you in this? We wanted to, as we start to look at these 24 veins, to ensure that we could, every point of light, how do you prioritize where you're going to go first? Our team had some pretty strong indications. We'd worked with some of the exploration people at SRK to prioritize. We thought that the AI stuff would be a good exercise to see how it played out. And we did get some very good intel out of that. We tested that against some of our findings, and we saw overlaps, so we took some confidence from that. So I think it's, it was really comforting for us to be able to prioritize targets, knowing that we had another set of fact data that confirmed what we were thinking of doing.
All right, and I think with that, Mike, we'll leave it here. We're just about 2 minutes over my outside goal of finishing this at 1 o'clock. So, and with that, we'll wrap up. Thank you very much, Mike, and thank you to all our presenters for being on today, and thank you to our audience for participating. We had a great turnout. Please feel free. This is our first mini virtual conference, so please feel free to send us any feedback that you might have on the presentation. I think it went well for a first start. Obviously, we're doing lots of webinars and virtual conferences going forward with this in the current environment. So tomorrow at 2 o'clock Eastern, we'll be hosting a webinar with Mako Mining. Please sign up and attend. On April 7th, we'll be hosting a webinar focused on gold fundamentals with Trey Reich. And next Wednesday, I'll be hosting at this same time, I'll be hosting a uranium mini conference. So look for the invites to those events, and go to our website if you are looking to sign up. Stay safe, and we'll see you all tomorrow. Thank you.